Most of us were raised inside a story. Not a story from a book, not a rule written in law, but a story passed down quietly from generation to generation. It goes like this. You grow up, you get a job, you stop renting, you buy a house. And once you buy a house, you've made it. You're responsible, you're stable, you're doing life correctly. Renting, on the other hand, is treated like failure, like you're behind, like you're wasting money. We're told that rent is throwing money away, that renters are paying someone else's mortgage instead of building their own future, that every rent payment disappears while every mortgage payment magically builds wealth. Over time, this belief becomes emotional. Then it becomes moral, and eventually it becomes identity. People don't just think buying a home is smart, they think it's what a good adult is supposed to do. And that pressure is powerful. It pushes people into buying homes they can barely afford. It convinces them to stretch their finances thin. It normalizes massive debt because the pain feels like proof of responsibility. But here is the uncomfortable truth. For millions of people today, this story no longer works. The economy has changed. Housing markets have changed. Interest rates, mobility, job markets, and risk have all changed. And blind faith in homeownership is no longer a guaranteed path to wealth. In many cases, it has become a financial trap disguised as maturity. A trap of high debt, low flexibility, high stress, and slow progress. So today, we're going to do something different. We're not going to argue emotionally. We're not going to judge personal choices. We're simply going to look at the math. We'll examine the hidden costs of owning. We'll compare them honestly to renting. And we'll see why, in many situations, a disciplined renter who invests the difference can end up with more wealth, more freedom, and less anxiety than someone who rushed into buying. Not because renting is morally better, not because owning is morally worse, but because money does not care about stories. It only responds to numbers. And when you actually run the numbers, the result is often surprising. What does throwing money away really mean? When you rent, the transaction is simple. You pay for housing services, a place to live, a location, maintenance, convenience. Once you pay, the money is gone. It doesn't come back. It doesn't build equity. So people label rent as waste. But when you buy a home, the story becomes comforting and misleading. You're told your payment is going into yourself, that it's forced savings, that it's an investment. This is only partially true, and in the early years, it's mostly false. Because a large portion of home ownership costs are just as unrecoverable as rent. They disappear forever. They don't increase your net worth, they don't build equity, they don't return to you. We call these unrecoverable costs, and they are the silent wealth drain of homeownership. Let's break them down. First, mortgage interest. This is the cost of renting money from the bank. In the early years of a 30-year mortgage, 70 to 80% of your payment often goes to interest, not equity. You might send $3,000 a month and only reduce your debt by a few hundred. The rest is gone. Second, property taxes. This is permanent rent paid to the government. In many areas, property taxes alone rival rent for a small apartment. Third, maintenance. Roofs fail, water heaters die, pipes leak, paint peels. A common estimate is 1 to 2% of the home's value every year forever. Fourth, insurance. And as climate risks rise, so do premiums. Fifth, transaction costs. Buying costs money. Selling costs even more. Agent fees, closing costs, legal fees, often 8 to 10% of the home's value each time you move. When you add all of this up, something shocking happens. The unrecoverable cost of owning often matches or exceeds the cost of renting the same home. You didn't escape rent, you just changed landlords. Now your landlords are banks, governments, insurers, and repair companies. And unlike rent, these costs come with risk, commitment, and low flexibility. The price-to-rent ratio. Once you understand unrecoverable costs, the decision becomes mathematical, and it centers around one key number: the price-to-rent ratio. It's calculated by dividing the home price by the annual rent of a similar home. If a home costs $500,000 and rents for $2,000 a month, that's $24,000 a year. $500,000 divided by $24,000 equals about 21. Historically, below 15, buying is attractive. Between 15 and 20, gray zone. Above 20, renting often wins. In many cities today, this ratio is 25, 30, or higher, which means housing is expensive relative to the service it provides. Buying in these markets is not shelter, it's speculation. Renting in these markets is not weakness, it's discipline. You're living inside a costly asset without owning the risk. You keep your capital liquid, diversified, mobile. That is not passive. That is strategy. The most dangerous cost of buying. The most destructive cost of buying isn't interest. It isn't taxes. It's the down payment. That $100,000 you lock into a home becomes trapped. It can't compound, it can't rebalance, it can't move. It becomes what we call dead equity. You're making a massive, concentrated bet on one city, one neighborhood, one asset. Historically, diversified investments grow faster than residential real estate. If that $100,000 earned 8% annually, it would double every 9 years. In 30 years, it could be life-changing. By renting and investing the difference, you're not avoiding wealth. You're redirecting it. From walls to markets, from bricks to businesses, from illiquid assets to compounding ones. Mobility is an asset. Mobility has financial value. Renters can follow opportunity. Homeowners pay to escape it. Moving costs can erase years of equity in a single sale. Buying assumes your current location will be ideal for the next decade. That is a risky assumption in a fast-changing world. Optionality has value. Flexibility is insurance. Inflation, stress, and lifestyle. Yes, rent rises with inflation, but investments rise too. And homeowners are not immune. Taxes, insurance, and repairs rise as well. Homeownership also comes with mental cost, maintenance, contractors, stress. Renting buys back time. Time can build skills, income, businesses, or health. Many people buy stability and accidentally buy stress. Final thoughts. Buying a home can be right, in the right context, but it should be a conscious choice, not a cultural reflex, not social pressure, not fear. A house is a place to live. It is not automatically a wealth machine. True wealth comes from productive assets that generate cash flow and compound. A house does not pay you. You pay the house. So, run the numbers. Check the price-to-rent ratio. Calculate unrecoverable costs. Think about opportunity cost, mobility, and optionality. And if the math says rent, rent with confidence. Invest the difference. Build your liquid portfolio.
Let your money work instead of trapping it. The goal is not to own a deed. The goal is to own your time, your freedom, and your future. Thanks for listening. I'll see you in the next one.